You're listening to Toronto's #1 real estate podcast, powered by Watson Estates. The most successful local real estate investing starts right here, right now. Here's your host, broker, investor, and social media influencer, Bradley Watson.
Good morning, investors. Bradley here from Watson Estates. It is June 1st, 2020. I hope you guys had a wonderful weekend. Here we are back with more, sharing everything there is to know about the local Toronto real estate market. That's a blanket statement. But today I want to talk about a few big topics, things that are happening in our news, things that I'm learning about and growing myself. I am a broker and a real estate investor here in the GTA. And so if I'm going to learn and read about it myself, why not share it with all you guys? So we're going to start off talking about how many mortgage deferrals are coming to Canada. How bad an issue is this, and what are the banks doing to prepare? Are they in a financial position to carry this burden as delinquencies mount up once this ability to defer your mortgage ends? And then we're going to transition talking to investors and how much money can you actually make in a condo anymore? Is there any profitability in it at all? And I'm sure many investors, and we've talked to some investors that are aware of this, but in case you don't know, we're going to share with you what that kind of looks like today. If you're ever wondering, how do I make money in a condo anymore? And then, when is the time to put your house for sale? There's an opinion piece I want to share and talk about what people are kind of discussing as an opportunity for them to list their property. We are #1 on Google Podcasts for Toronto real estate. Thank you all for tuning in on a daily basis as the news mounts and we continue to share with you all the great stuff going on in our local market. Kind of taking an outside perspective, I cannot be any more thankful to live in a country like Canada as I see what's going on in the States and people are losing their mind over this George Floyd death. It is crazy what's going on down there all across the country. And so once again, thank you, Canada, for being so awesome. The news that I want to be hearing is something like this. Did you know that drive-in movie theaters are now allowed to reopen? Woohoo! We went to the zoo this weekend. We had a good old time driving through there. I don't remember what they call it. It's kind of a little safari thing. It was fun trying to spot the animals. And here's some other news that's interesting. Make you guys feel a little more pep in your step today. Stand a little bit more shoulders up high and confident while you're sitting at home by yourself. Canadian accents rank, did you know this? Number 13 in sexiest accent poll. So apparently we all sound a whole bunch of sexy. Nyai, haven't seen you in a minute, bro. Still. That's my Canadian accent. All right, let's get into some real estate. We're going to have some fun today. TransUnion warns a, quote, severe scenario likely in Canada as mortgage defaults to jump. So this comes from Better Dwelling. Let's get us all spiced up here. Talk about some of the less glamorous side of our market and what's going on in the banks. So one of the, quote, big three credit agencies, this is talking about TransUnion. If you've never heard of TransUnion, they're huge. Warned they expect a big jump for insolvencies. TransUnion gave the industry a look at recent macroeconomic and consumer credit activity this week. During the presentation, the firm's analysts highlighted various deteriorating macro events. They warned lenders to expect a rising wave of defaults as a, quote, severe risk scenario plays out. So they had these different scenarios of what could happen. And based on everything that they've seen going on, they're now saying we're kind of in this severe scenario. It's the most likely scenario. They analyzed 40 different metrics, including forbearance and credit, and the, quote, base case before the pandemic saw slowing credit growth and rising delinquencies. This is kind of what we were hoping for. But however, due to what we're seeing in these recent developments, it actually seems more like we're entering their prediction for a severe scenario. So what does that look like? Well, Canadian mortgage delinquencies are expected to rise 200%. So we're expecting to see double. In other words, actually rise by 100. That's actually triple. Technically, that's triple. So in the severe scenario, they expect the mortgage market will be hit fairly hard. By Q3 2020, they expect mortgage originations to drop by 43%. So mortgage originations are new mortgages, new mortgage applications. So this speaks specifically to new purchases or, like the people are just kind of staying put where they're at. Average balances rise by 20%, right? So this is the deferrals. So in theory, people are deferring up to 20% of their loan. That sounds a little bit high to me, but that's what they're saying, so we'll go with it. As people stop aggressively paying off balances. Like people have the opportunity now to not pay anything. I'm going to kick the can down the road, and that's what they've been doing. I'm actually putting together our video for this Wednesday. We like to release a weekly video just so you can see our face. When I say our face, I mean my face in the plural. I talk in the plural sometimes because I'm a little silly like that. But you're going to see me, and I'm going to be talking probably about this, because this idea of defaults and how the banks are going to protect themselves, I think, is probably one of the big issues that has a lot of news around it right now and needs a lot more clarity, because there's some uncertainty what that's going to look like. That could be catastrophic to our real estate market if it tips off the scales. And the banks are doing what they can. We're going to talk about that in a minute. But we're seeing some craziness here. Most interesting, the delinquency rate could rise 200%. So triple. Over the long term, the firm also warned, quote, entire sectors of the economy will have long-lasting impacts and some may not recover. So they were saying like travel, small business, which applies to a lot of people, ride sharing, interesting, and commercial real estate, which we've seen. Commercial real estate, not a fun time to be a commercial real estate agent. I would just quit, but that's me. Anyways, so where this kind of starts here. So we see this idea of defaults. These are some of the stats by Better Dwelling, so they don't hold back. But now let's talk about also a Better Dwelling article. So we're going extreme here. Is this idea of what are the banks doing, right? And this actually isn't as negative as I thought. This actually is one of the more fact-based articles I've seen out of Better Dwelling. So I want to share with you, Canada's big six banks set aside over $10 billion for bad loans, up over 300%. This isn't an opinion. These are the numbers. These are the figures. Canada's big six banks are preparing for a lot more bad loans. Canadian banks reported Q2 earnings this week. So if you're wondering, like, why am I hearing about all this right now? It's because of their Q2s are being released. And a common theme, early last week we were talking about how you're going to see more news about this. Well, here's the news. A common theme in all these reports was a sharp increase in the provisions for this thing called provisions for credit losses, PCLs, okay? It's not something that people usually use, not a word that I use at all. It's an accounting term, really. And what it is, if you were to explain it, it is bad loan expectations, and it's found in financial reports. It's a dollar value that you deduct from the income equal to the amount anticipated in loan losses. So when a business thinks, you know what, like we're probably not going to be able to recover this amount, it goes towards a loss, which goes against their income. And so we're starting to see the banks on paper are losing all this money. And the reason they're losing all the money on paper is because they're anticipating bad loans to come in the future, which as a consumer, we should start to think, well, then if they're anticipating that, yes, it's a worst case scenario and all of it won't happen. Like all of this money being set aside is not going to come to fruition. But the fact that they're doing it as a business makes us kind of turn our head and say, okay, well, maybe there's some validity to this. What could this mean for our local real estate market? This is why we've been tracking it. And these debts are considered unrecoverable. When PCLs rise, a firm is expecting more loans likely to default or become unrecoverable. If PCLs fall, they're seeing lower risk and fewer loans likely to default or become unrecoverable. So here's the thing. Across the board, we've seen 346.42% increase with relates to the big six banks. Earnings reports reached 10.9 billion, up from 2.45 billion last year. So that's the amount. So it was 2.45 and it went up to over $10 billion. So a big jump. And when we break it down, RBC had the biggest jump. They went up 564% from the year before. Then followed by BMO, who's up 530%. And then Scotiabank is the one that has the least. And they have a 111% increase from last year. Still a big increase, but nowhere near 500%. And all of this stems from this PCL section that's coming from the banks. Maybe it's funny that we're kind of digging into this one aspect of their financial statements, but it's funny when you look at the banks overall, they're pretty strong. The PCL seems to be the one thing that's kind of like a warning sign, if you will, of what's to come. And here's something that's important to note as well. Credit delinquencies have rose from last year, but they actually came off their record lows. So we're not dealing with like already high delinquencies. We actually had a really low delinquencies, and now we're starting to see this potential increase. Not an increase, a potential or an expected increase. So it'll be interesting to see if it actually pans out, but the banks are ready if it does. The takeaway is your bank is fine and prepared for increased delinquencies. The bad news is your bank is expecting a lot of people won't be able to pay their bills. And if they can't pay their bills, what happens next? Well, the bank takes the property and they list it for sale, right? So this is why this would immediately impact our real estate market, assuming the people who aren't desperate to sell cannot wait any longer. We see the activity still there, but also we see this influx of power of sales hitting our market. Of course, that would dampen real estate prices. And this is why this matters. Now, is this going to happen? Not necessarily, but they're ready if it does. And if it does, it could affect our prices. So again, you be the judge, you determine the forecast. All I'm going to do here is share with you what's been going on in our latest news. And we have people on either side. I tend to be more optimistic, and a lot of people don't like that I'm optimistic, but that's fine. Why are you spending time listening to my podcast if you don't want optimism? But then again, there's people who are optimistic about the market crashing. And they look at it from a perspective, oh, this is a good thing too, because this means opportunities for young people who might not be able to afford a property. Now, I mean, generally speaking, I think our market is going to come out really strong and resilient, and that's what I'm seeing today. But ultimately, you be the judge, you determine your own fate, and you make your investments accordingly. Okay, so let's talk about investments. Let's transition into this idea of if you were trying to invest in a condo, like we know 5-10 years ago, if you invested in a condo, you could make a cash flow, right? Your expenses, in other words, were lower than your income. So you were able to generate money, generate a profit. A lot of people would buy these units and they were going up in price very quickly as a result, right? But now, out of the Huffington Post, we have this kind of report. It's from TorontoRentals.com and Bullpen Research and Consulting. They had a report that explained that units in several freshly finished condo buildings have seen between 200, which is more normal, to 600 in monthly negative cash flow. Actually, the 600 is pretty normal too, I'll be honest with you. I don't know if 600, but definitely around $400 or $500 negative. Based on local listing data from the rental website and new condo pricing collected from BuzzBuzz Home. So the main subheading here is units in some newly built towers are losing up to $600 a month. Okay. Now, you might think, well, that sounds not so good. You're right. That's not so good, especially from the perspective of trying to find investors that would be able to provide long-term rentals for people. So then the thinking is, you know what, screw it. I don't want to invest in the rental market in Toronto, which would, of course, affect the production of rentals. But this isn't new information, by the way. So if you think, oh, well, this is crazy and this is going to be catastrophic. Well, I mean, even early on when I started putting out YouTube videos a few years back, I don't know how long I've been doing it now. We'll call it 2.5 years ago, let's say 3 years ago. We actually made a video that said there's no more cash flow in condos. And we talked about this very subject. So this isn't a new thing. And one of the things that I would comment before we go any further is, in a scenario where you're still losing $500-$600 a month, that doesn't deter investors. It just changes the type of investor, because that's a monthly amount. But when we factor in the fact there's going to be a mortgage, the reason that amount is negative, by the way, is there's a mortgage on that property. But if you are in a financial position as an investor to carry the negative cash flow on a monthly basis, there is still a ton of equity growth that's happening in these spaces in the GTA. Right? So if I'm like, let's say, losing $600 a month, or let's call it $500 for easy math, that's $6,000 a year. Let me ask you a question. Do you think over the next 5 years, on average, you're going to see more than $6,000 a year in returns? Absolutely. Absolutely. And that's why they're okay with taking these monthly amounts. But for a smaller investor, you guys are going to get, once again, weeded out and crushed. And I'll give you an example. A 632 square foot unit in Kingley Condos experienced negative cash flow of $618. So this is based on a monthly carrying cost of $32.70. And in 2019, the average rent of a unit was $28.67. But recently, as we know, as we've kind of been tracking, the rent prices are going down and they've come down to $26.50. That's a pretty big jump. In fact, that's $230 roughly year over year. That's a big drop, right, for this new development. And so all of a sudden, if you're making $226.50, but you got to pay $32.70 for that little pie in the sky, we have ourselves a problem. Houston, we're sinking, right, on a monthly basis. And not to mention, if we get fluctuations in price and you're still paying that mortgage, that gets some small investors a little bit freaked out. This is the stuff that's going on. Now, has anything changed in my book? Nah, not really. Let's say that even was at $28.67. They were already in the hole $400. We just boosted it up an extra $200. So this isn't new, but these are things that we need to keep in mind. And this is what a lot of investors are looking at when they start to think, you know what, maybe I'm going to be looking for a multifamily, right? Or maybe I'm going to be looking outside the city or driving further out. If cash flow is a big thing for you and you don't have the down payment, you need to go further out. If you do have the down payment, then you can buy your way back into positive cash flow. These are some of the thoughts, but this is interesting stuff, right? So, quote, this pandemic could have a real impact on the supply of new housing in the GTA in the long term, as missed payments by tenants and lower rents could have many investors rethinking future pre-construction condo purchases. I have a client right now who is sitting on the sidelines, actively on the sidelines, watching to see what's been going on in our rental market. And they are aware and they're educated, and I'm seeing them on at least a weekly basis. So they know the rental market is a tough one right now. So they're thinking, okay, well, maybe I should be considering a pre-construction where I don't have to worry about the monthly thing. I don't have to hold and rack up all this stuff. I mean, I don't have to pay a mortgage, and I'm not kind of building that equity up. But in the same token, I don't have these expenses. So pre-construction actually looks like not that bad an idea for this particular person. And what I think you're going to do, what you're going to see right now is that the pre-construction guys are actually taking a bit of a hit. They are having trouble selling units, and we've seen this in statistics. And even the production, like the costs are so much higher. And it's going to be a little bit more rough for pre-construction than it has been historically, especially in the last few years when it's been easy. You launch a product and all of a sudden it's gone overnight. But as they're releasing this stuff, they have to actually be more hesitant. So what that's going to do is the builders are going to start pulling back and say, well, maybe we wait. Maybe we only sell half the units and we follow it up a little bit later. And so you're going to see less supply coming in the market. And as we know, following this podcast as well, supply is a not so great thing here in the GTA, right? Like we already have a huge supply, putting a lot of pressure on prices. And so this is doing nobody any good, right? Like this scenario of not generating a profit for investors, if it in fact does trigger anything, it's going to trigger speeding up of equity in the long term, because we're not going to have that supply that we need coming on the market anymore, because investors aren't going to be buying that product anymore. The only people going to be buying it are kind of what we've been seeing, which are people who are planning on moving in themselves, which doesn't really help our rental market. Okay, quote, these buyers help developers reach pre-construction sales targets, and a decline in investors will result in significantly less new housing supply in 4 to 5 years if these purchasers change their condo buying habits, right? I hope you guys are starting to see what this means. What are the implications of this, right? You think, oh, it's just about cash flow. It's like, there's not a lot of money, but you and everybody else is seeing, you know what, $600 negative return per month. I could do so much better, right? I can do so much better. And so if that means that investors are leaving, then the question is, well, how many investors were propping up our market? Oh, well, you know what? We can just do long-term rentals. Well, wait a minute. Maybe not. So developments completed after November 8, 2018 are not subject to rent control in Ontario. This is another factor. And investors in those buildings are more likely, check this out, this is a good thought, to decrease their asking rent short-term, knowing they can raise them to the market rent when the economy and real estate recovers. Good point. This is a very good point. I've never heard anyone even suggest this. This is a great point, okay? So rent control before 2018, you can't do it. But anything developed after 2018 is not subject to this rent control. So looking at these new buildings is actually interesting, because right now, it's such a good price, such a good deal. These guys are giving you great discounts, but it's because they know that when 2021 hits, they're able to jack your rent up back to the market amount. So they'll take a little haircut this year in order to get a tenant because they're competing. So what this is doing, as any type of regulation does, is it's creating an unfair playing field. People who have had units that are pre-2018, which is the vast majority of units, are now less competitive than the new ones, right? So it's actually cheaper currently for you to be enticed into a new build, because all of a sudden it's so much less, and it's bringing down the rent rates of everybody else, but they're doing it because they think on the other end, we're going to be able to jack the rents back up. And that's going to be your scenario as a tenant. But the question, I guess, overall is, will it? Will it rebound the rent? I don't know. So this factor, plus the incentives offered, shows the market may be softer than our data shows. So these are things to keep in mind, guys. Interesting stuff. If you're ever considering investing in the GTA and you want to ask some questions specific to your marketplace, whether it's in Toronto or outside the city, feel free to give me a shout. My info's splattered all over the internet. You can reach me directly, no problem. I'm happy to discuss and share with you. I'm running around with like a chicken with his head cut off right now, because it seems to be kind of a delayed spring market right now. But I always have time to make new friends. So let's be friends. Okay, let's talk about this last topic and this question that comes from globalnews.ca. When is the right time to put your house up for sale in Ontario? Well, this was an interesting article. And there's a couple of points in here that I thought, you know what, let's talk about this, and let's kind of talk about what that looks like for people. So, and what I also liked about this article is it talks about East and West. It talks about Kitchener-Waterloo, and it talks about, where's the other side? Kingston, Ontario, and people in Toronto. So a nice little kind of putting out feelers, right, across our GTA. the sexiest language here in Canada. That's hilarious. Did you ever think, talk to me in Canadian? All right. Knowing the best time to sell your house is challenging at the best of times, but during the coronavirus pandemic, it's even trickier. Toronto real estate agent broker Brandon Powell says, forget any crystal ball you've got. They're all broken. This is true. And if your crystal ball is an economist from your favorite bank, they're broken too. Everybody's broken. We all got broken balls these days. All right. The idea of trying to time the market right now is about as dangerous as it can be because you could be totally wrong and nobody really knows. It's another way of saying the same thing, right? Nobody knows. I don't know. I'm a broker, I'm an investor, and I'm learning too. This is why I have to stay in tune with what's going on because opportunities pop up overnight. Right now, the housing market is on the upswing after a free fall that was mainly due to the lack of inventory, according to several realtors from across Ontario. Okay, here's what's going on, guys. You'll remember a week and a half ago, we talked about this potential of making sure your grandma has a neck brace because we're about to experience a serious whiplash. Hopefully that little joke or that little humor there reminds you that we've talked about this. This isn't new. The idea was this, okay? Who comes first, buyers or sellers? Everybody's hiding. They're all hiding underneath their staircase right now with little masks on and gloves and hand sanitizer. But now the question is who comes back first? Is it the buyers or the sellers? And I tend to think it would be the buyers, right? And as a result of buyers coming back, the sellers would come back. And that is exactly what seems to be happening. And this is why we have such huge competition right now in certain pockets of our city, certain segments of the market. Right? So what's happening is there is now a lack of inventory, but a boost in demand, an increase in showings like crazy, and it's leading to bidding wars. We're talking double digits, multiple double digits bidding wars from east to west. Okay. And this is causing obviously a sharp price increase. Now, the interesting thing is this going to be long-term or not? Probably not, right? Like we've got a spike. Now in the long term prices will go up, but will they stay this high in the next couple months? It's hard to say because what we saw back in 2008, we've talked about this in a past podcast as well, is we see this kind of second drop that hits the market. So if you can kind of picture it, it almost looks like, if I were to try and give you a visual, it looks like a heartbeat, right? Like imagine you're watching this kind of EKG or whatever they call it these days, and you've got this drop. Okay, you've got a drop that happens. That's what we saw. But then all of a sudden it goes right back up. Ding, it goes right back up all the way up to the top. But then it comes back down to a level playing field. That level playing field being our 6% increase year over year, or this steady growth that we've seen in our marketplace. So you get this very sharp increase, but then you get this rebound that puts you kind of back in line with where you were. So if you can play within that fluctuation, that's where the game is. That's where the money is made. But unfortunately, real estate, the speed at which it happens is so much quicker than you can purchase and close, and the time it is brutal, which is why we see people like Rain saying, don't flip, right? Like don't if you're a flipper, get off the sidelines. Like don't get off the sidelines. That's literally the opposite. Don't go out there and do it, right? You're better to buy and hold. Buy and hold is the play. And so we've seen this, what they're describing here as a whiplash effect, and sales are down. It's simply because people aren't listing their houses. So this comes from a realtor. Actually, the Association of Realtors president in Kitchener-Waterloo, they said that the issue is sales are down because the listings aren't there, right? The media would have you believe the sales aren't there because the buyers aren't there, or the sales or this. And some people would argue, which I think is my thought on it, is people aren't selling because the buyers aren't there. So it's kind of both true, right? The buyers and the sellers aren't there, but the sales are down because the listings aren't there ultimately. Right? If the sales were down, but the listings were there, that's where we would have a problem. If they were listed, we would be in a totally different ball game. So they're obviously very optimistic about the market. When we kind of jump over east, we go to Kingston, Ontario. Another realtor says 5 houses a day coming on the market in April, whereas we're talking, normally we see 45 or 40 to 50 new listings, but in May, he said he's seen between 20 to 30 listings a day. These guys are tracking this thing pretty hardcore. I don't know if I'm tracking it even that hard, but okay, we'll take what you're saying as the gospel here. East End, Kingston, Ontario, roughly in April, they were seeing 5 houses a day, and in May, they saw 20 to 30. So by those numbers, you're talking 4 to 6 times the number of listings. So is that a response to buyers coming back? Perhaps. Is that a response to prices coming back? Perhaps. But it'll be interesting to see when stats come out in the next realistically, probably before the end of the week. If it's Monday now, probably by Friday, we will have a very, very, very clear picture that we've been waiting for weeks on where it stands. If the sales are going up and the active listings are in the same pace as the transactions, we'll be fine. But we could see a spread start to happen. But if there is a spread in my book, I think it's going to be in favor of driving price up. That's my thought. If I were to cast my bet, that's my bet. Okay, you've heard it here. We have definitely found that buyer confidence has returned. Offers on a home in Kitchener, Ontario. He had one property that he helped the client that they got 26 competing offers. So if you're like, oh, Bradley, you're telling us examples. Like I had one the other day, we had 4. That's nothing, right? Like that's nothing. But these are preemptive offers. This is what's going on too, guys. This is another layer to this. There's competing offers where it's like, I'm going to put your property up today, and then I'm going to give it 5 days, and we're going to take an offer. But then there's preemptive bidding wars that are happening. So I'm going to give you until, let's say, Monday next week. But then on Thursday, I got 4 or 5 offers. These are not just waiting for a presentation date. These are multiple offers ready to jump in early, bidding up these prices. So the way that you market your property and when you take those offers, that's up to you. That's part of the strategy. That's part of the fun. That's where we can personalize things for you and get the best dollar. And ultimately, this bidding war is driving prices up huge. So then they talk about this other agent. We're not predicting anything because nobody knows. And if anybody tells you they know, they probably don't know either. Valid, very valid. All right. So I don't want to beat this any further. I think you guys are getting the idea. It'll be very interesting on Friday to see what happens as far as prices, I'd be interested to see the number of showings, what that looks like, because it's going through the roof. It's crazy. The amount of lock boxes does seem to be increasing when I'm kind of checking out these condos. And I find it so humorous to see how many lock boxes you can really have in a building. You're like, are there really this many listed? Makes you wonder if some of them are maybe set up for Airbnbs or whatever, but there's a ton of them. And so it'll be interesting to see how everything plays out. And so make sure you stay in tune. But the main thing here is all this pressure actually means that there's still a discount out there, right? Like there's still a discount, all of this media pressure. And so if someone's just like thinking that the prices are going to go through the roof, perhaps if they're going to go down, perhaps. But the reality is that on a macro level, we're standing in a very good position when we look in the long term. Say a word. So you say Mad's getting a discount, dog? Scene. Stay sexy, Canada. I'll see you guys tomorrow morning with more. Make sure you hit the subscribe, leave us a comment. If there's anything you want us to talk about, and also keep an eye out on Wednesday as we kind of dive more into this mortgage default side and we kind of clear the air, as it were, about what's been going on in these PCLs. I'll see you next time. Take care and keep it real.